This is Yet Trade. I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are poised to follow Wall Street's declines as a disappointing consumer confidence reading fuels concerns about the US economy. Ukraine's leader set to seal a minerals deal with the US during a Friday meeting with President Trump, potentially easing tensions over ending the war with Russia. And Australia's corporate watchdog releasing a new report into the state of capital markets. We'll be discussing those findings with the ASIC Chair Joseph Longo. Let's get you straight to the markets and pretty muted expectations. Stocks across Asia broadly set up to follow the drop in the US. We saw another disappointing reading when it comes to consumer confidence, fueling these concerns about US economic health, particularly in the light of these inflationary risks coming from potential Trump tariffs and some of the immigration and other policy measures as well. We saw a rally in treasuries there, 10-year yields to their lowest levels this year. This is a setup as we get into just that staggered trade here in Australia. A little bit of downside there, and we've had this market trading now lower for 7 out of the past 8 sessions there. We are watching in particular some of the sort of earnings and corporate news related names like WiseTech is one to watch today. We're also expecting potentially copper shares to be in focus in the Asian session. Donald Trump signing an executive action directing the Commerce Department to look at possible copper tariffs more broadly. So watching for those producers and miners in this session. Nikkei futures looking like we're seeing a bit of upside of about 0.3%. Dollar yen still sitting pretty comfortably under that 150 level there, and that's what we're seeing when it comes to trading in the yuan, as well as the yen hitting that 4-month high on a bit of haven demand there. We have seen that slipping in the US dollar index, though, weakening in light of that consumer confidence report, with the yen subsequently touching the highest levels since October. Again, these sort of building expectations, given that we have had those CPI, PPI readings from Japan, just building on the narrative of continued rate hikes from the Bank of Japan. We are seeing the US dollar at this point kind of trading within the sort of weaker side of that gauge. Taking a look at what else we're watching when it comes to oil prices at the moment, we did see that slump to the lowest levels this year, and we kind of see that sort of demand side pessimism starting to build up. We had about a 2.5% drop when it comes to crude to about $69 a barrel. This is the lowest closing price all year, again on the back of the US consumer confidence numbers and that slump in equity markets. So much of this being wrapped up in the Trump tariff threats, the economic weakness that we continue to see out of China, as well as potential more release of energy supplies, right, depending on what happens with Russia. Well, let's get back to that consumer confidence reading, falling this month by the most since August 2021 on concerns about the broader economy. The drop highlights just the uncertainty that the Trump administration's policies are creating for households. For more, let's bring up Bloomberg global economy correspondent Enda Curran. So, Enda, what do you make of this reading, and what sort of a broader picture is it painting just a couple of months into the Trump administration?
Well, it's a sizable drop, Heidi, 7 points to 98.3. And interestingly, in terms of the details of the survey, across all age groups, across all income groups, there are shared concerns about the current jobs market, the outlook for the jobs market, the outlook for earnings. And it gels with this kind of emerging idea over recent weeks now that both consumers and businesses are getting a little bit unnerved in terms of the impact of potential tariffs and where trade policy is going. And of course, the efforts to cut public spending being led by Elon Musk and Doge, that's also filtering down. And we're starting to see bubble up in terms of these sentiment indicators, such as this one from the conference board today, suggesting that consumers are getting unsettled. It's early days, of course, a long way to go in terms of this administration. But right here, right now, certainly a bit of a jolt in terms of where things were post-President Trump's election in November.
It's pretty difficult, Enda, when it comes to modelling the possible scenarios. But is there one scenario that's becoming perhaps a little bit more stark, where we see the US ending up in stagflationary conditions?
Well, we're not there yet. I mean, on the one hand, the economy came into the new administration in relatively good order in terms of the aggregate data, at least. GDP holding up, labour market still tight, inflation broadly at least heading in the right direction. But, there are concerns now that maybe some of that disinflation story is starting to seize up again. So the inflation story hasn't gone away. That puts the Fed in a hard spot. There are worries that the labour market might start to soften over the months ahead. And I think it's also the uncertainty part of it more than anything else, Heidi. People don't quite yet know what the trade policy or tariff policies will be, what tariffs will be implemented, how will that impact the price of goods, how will it impact business plans to invest and hire and employ, and all the rest of it. Now, to be clear, the administration says they're sticking to their course. There will be short-term pain, but ultimately their policies will drive growth, bring down the cost of energy, and generate more investment and more manufacturing jobs at home. But as I say, right here, right now, there's certainly a sense that there's a sense of unease, I think, going through both financial markets and the consumers and businesses as they look for clarity on where the policies are headed.
We saw some downside in emerging market assets as Trump continues to put pressure on China, right, through various means, including sort of new restrictive policies on CFIUS and the such. Can you see kind of points of potential vulnerability within Asia, or is everyone kind of being tarred by the broad brush of tariff threats at this point?
Well, there's no doubt the reciprocal tariff concept does push it well beyond the kind of trade war we'd become familiar with China, Heidi. I mean, if you get into the world of reciprocal tariffs, that's going through the books with everyone that the US does business with, looking for a levelling up. And there will, of course, be some of those vulnerable. And I mean, certainly Asia, as a broader manufacturing base, is vulnerable. We all know about Vietnam, for example. That's played a leading role in the supply chain and manufacturing story in recent years. So that is a standout. The other side, of course, of the US spillover story remains the strong dollar. That does continue to weigh on emerging markets, and of course, with the prospect for inflation perhaps stalling where it is in the US right now, several economists on Wall Street say maybe the Fed will not be cutting interest rates. That means high yields, stronger dollar, also impacting the emerging market world. So a lot of what's going on in Washington today and over the months ahead will certainly impact the rest of the world, and I'm sure Asia is watching it very closely.
Bloomberg Global Economy correspondent Enda Karan there. Let's take a look at the market perspective now. Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, if the markets are going to be complacent about the tariff risk, do these, hard data points make more of an impact in terms of reassessing the real economic risk?
Well, very much so. I mean, there has been, some creeping unease about what's going on with tariffs, especially because there's been so much of a back and forth. We looked, Bloomberg looked last week at the idea that the first part of this year hasn't seen the sort of merger boom that had been expected under Trump with his reflationary, deregulatory bent. So that's shown that there was some concern for businesses about that. But now this data signalling that households are losing confidence and that they're seeing their inflation expectations come up, that's a double whammy for markets, precisely because consumer spending has been the key driver of the economy, and there was lots of fear over the last, say, 18 months or so that at some stage the post-pandemic savings glut would run out, and so people would slow their spending. There's a lot of signs of the savings glut ran out, but the spending kept going. When you've got households turning pessimistic in this way, that raises a concern that drop in spending, or at least slowing in spending, could come through. And if that comes through at the same time that inflation expectations are rising, and that's tying the Fed's hands, then you're heading down a bit of a blind alley as far as the economy goes, and in particular as far as the economy's impact on companies. Services are 70% of the US economy, famously. They're a big part of the major indexes for equities. So if they're in trouble because consumers are no longer spending, then those AI-fueled extreme valuations that we've seen for a lot of sectors of the US equities market, those look in serious danger.
What are the implications for the US dollar then? And conversely, we've seen the move in the yen as well.
Well, the US dollar is another Trump trade that's fallen over, and it is one of those interesting things that Trump ultimately, in his first term, sort of endorsed a strong dollar, although he didn't want it to be too strong. We've had increasing chatter that the current Trump administration is interested in a weaker dollar. Treasury Secretary Bessent emphasised that, weaker dollar, lower yields, in his comments overnight. So that's an impulse in and of itself, separate from the tariff impact. But as you've got this turning towards the idea that tariffs might be bad for US growth, that also takes away a major prop for the US dollar, because tariffs had been seen as being good for the US dollar because the economic pain that was going to be inflicted on other economies was greater. Now that thesis is being thrown into doubt. There were a lot of people that were very long the dollar for a long time, and there are signs again that trade is starting to unwind, and Japan, the yen is one of the obvious beneficiaries of that. You could also see the yuan turn around at some stage, depending on what happens with the confrontations there, and for that matter, the Australian dollar has been very sensitive to tariff concerns as a sort of global proxy. And when you consider that the RBA has cut once but said we're going to wait, you could actually see the Australian dollar come climbing up.
Bloomberg's Garfield Reynolds there, and as we're speaking, we're seeing Truth Social posting by President Trump covering a range of issues, including his views when it comes to copper imports. Of course, he's asked the Commerce Secretary to take a look into copper imports, saying that copper should be made in America with no exemptions, that copper should, and I quote, come home. He's also referring to the AI revolution, saying that if companies want that, they need to choose sides with the US, and posting more about the role of tariffs in terms of company investments as well, to go only where the United States is treated well. Well, Trump says the US will consider lifting sanctions on Russia at some point as the White House works to broker the end of the war in Ukraine. Trump also says that he's opened Volodymyr Zelenskiy visiting Washington on Friday as Ukraine agreed to a minerals deal with the US. Let's bring in Bloomberg's Michael Heath. So, Mike, we've been seeing this sort of play out. First of all, what are the implications of this minerals deal?
It's fairly significant, I think, Heidi. In many respects, almost as a public relations exercise, that Ukraine is sort of demonstrating a willingness to meet the Trump administration halfway, and it again shows Volodymyr Zelenskyy's ability as a negotiator with a bad hand to try and get the best of a bad hand. He's managed to remove this $500 billion idea of the US being entitled to that from its support to Ukraine, and in many respects, it's sort of a headline agreement. There's a lot of details to be worked out. It doesn't give Ukraine the security guarantees which it sought that was sort of very important to it, but I think that the feeling in Ukraine is that if they've got the US on board and things like surveying what minerals Ukraine has, all that sort of thing, if you get US officials in there doing that, US businesses working that way, sort of makes it more difficult for Russia to come again and get involved in the country. So I think it is significant, and just as a means of perhaps drawing a line under the tensions that emerged, or some of the pretty harsh rhetoric from Donald Trump towards Zelenskiy, calling him a dictator and demanding that Ukraine sign this agreement. If they can come together, have a signature ceremony on Friday and some warm words, then that at least sort of puts Ukraine back on a more level footing in terms of trying to forge this peace agreement.
We've seen, of course, Trump threatening to step away from backing European security, and that's really caused consternation and a kind of an existential debate within Europe, right? And we're now seeing the UK actually kind of rise to that when it comes to lifting defence spending. Yeah,
I mean, and I think this is really significant, Heidi, because we've also got the UK Prime Minister going to Washington to meet with Trump, and this is sort of, I think, the UK demonstrating that, again, it wants to play this role as the bridge, historical role as the bridge between the US and Europe. And I mean, it's sort of a turnaround for the UK administration too. They were wanting to be a Labor government that spent on infrastructure and public services, and instead they're finding that they're going to have to ramp up military spending, and that's going to come at the expense of the aid budget. Very un-Labor-like, but it shows basically the sort of global inflection point we're at, I think, here. And they're talking about boosting their spending to 3% of GDP. So it's a really significant turnaround, and it is a real olive branch, I think, from the Labor administration in the UK to Trump and to Washington, and trying to sort of keep Europe in play in terms of negotiating with Europe and Russia and with Ukraine and Russia in terms of this agreement or prospective agreement. The other thing that the UK Prime Minister said that was significant, he said you have to spend up big on defence because the only thing that tyrants like Vladimir Putin understand is force, and that's exactly right. So I think there's a lot of plaudits even from the other side, from the Conservative opposition for what the government's done there.
Bloomberg editor Michael Heath there. Well, coming up in the Asia trade, the Australian Securities and Investment Commission joining us to discuss the state of public and private markets in the country with a new report. We'll also be talking US-China tech with Eurasia Group as Washington continues to tighten chip controls over Beijing. A little bit later on, Standard Chartered will be along with us to tell us why they still have a preference for US equities over Chinese stocks. This is Bloomberg. Take a look at how we're setting up. We're just about 17 minutes into the start of cash trading. Another down session when it comes to the ASIC 200. I think we're off for 7 out of the past 8 sessions now. This, of course, as we had broad downside in the US as well. That US consumer confidence report really kind of hitting home the deeper uncertainty that we're seeing from Trump's tariff threats and some of the ongoing global uncertainty there as well. We're seeing a bit of upside when it comes to the Aussie dollar as the US dollar continue to trade on the weaker side of its range. Well, Australia's corporate watchdog is reviewing regulatory oversight of private markets. The Australian Securities and Investments Commission has released a paper examining why public listings have fallen out of favour, the rapid growth of private market allocations and the outsized influence of the country's superannuation funds. Joining us now is ASIC Chair Joseph Longo. Joe, really great to have you with us. So,
thank you, Heidi. Pleasure to be here.
First of all, why now in terms of this report and this investigation?
Well, it's a convergence of factors. We've been looking at this now for over 6 months. As we know, internationally, there's been over the years a concern about de-equitisation, the reduction of listings on equities markets, not only in Australia but globally. For example, in Singapore, they formed a review group last year, and their first set of their findings were published last Friday. So we're not the only country looking at our public markets. And then you're looking at our public markets, you're sort of driven to looking at private markets because the dynamic seems to be, well, people are not going to the public markets, they're transacting and raising capital a lot more in the private market. So there's that kind of theme. There are a couple of other themes at work here. The other one is the growth of superannuation in this country. And so when we're looking at our public markets, between a third and a quarter of the ASX is actually superannuation funds, between APRA-regulated funds and self-managed superannuation funds. There's a lot going on there as well. And a third factor for me, and just really stepping back, is we want to understand these dynamics, shifting between private and public. So in Australia, there's been quite an explosive growth in activity in the private markets, private credit, private equity. So we want to understand what's going on there. And finally, and this is really from a regulatory perspective, Australia remains an attractive place to invest. I think we're competitive, attractive place to invest. And I want to understand these dynamics because I don't want regulatory issues to be part of the problem. So it's sometimes said, oh, well, people aren't listing on the public markets because they're worried about the regulatory burden. And I would say, well, let's talk about that. You know, what are you talking about? And what our discussion paper says is we're not convinced that regulatory issues are the main driver that are dissuading people from playing in the public markets and going to private. We have an open mind about it, but we're not persuaded that's the issue. So what this paper does is say to the market, well, look, if there's something ASIC can be doing differently that's going to level things up a bit and make the public markets more attractive, then we're open to having that discussion. And indeed, we've been getting some confidential submissions asking us to look at a couple of issues at the moment.
And that kind of does lead me to want to know then if the regulatory burden is not the issue, then what are the contributors to making public markets kind of stagnant and less appealing?
Well, I think we need to keep an open mind about that. The other feature here, of course, in Australia is the listing rules. I mean, we don't make the listing rules, it's a matter for the ASX. And we've been working more closely with the ASX in more recent times and encouraging them to say, well, come on, you need to be more proactive about reviewing your rules to see whether there's a problem with them. But as things stand, we don't think regulatory settings are really driving people away from the public markets. Now, having said that, in Australia, the data is in the paper. We, unlike the US, where the private markets are really a huge part of what's going on there, the situation in Australia is we're going to be coming off a lower base. But what's really interesting about the Australian situation is how quickly the private markets have been growing the last 3 months, particularly private credit.
Do you identify risks within that?
Well, that's what we're concerned about. See, I think one of the big issues, and this is something Larry Fink's been talking about and Howard Marks, is that what we're concerned about is we can't do our job in the dark. And I think there's a real issue about whether we've got sufficient data. Now, when you look at our paper, we've got some data from Preqin, from APRA, from the Reserve Bank, and indeed from the industry itself. But it's an incomplete picture. And so one of the things we're calling for in the paper is greater level of transparency, and that may require some law reform. The other thing I've been talking about more and more is that this is a sector that isn't used to regulatory scrutiny. And my message is, please help us. We want to understand what's going on in the private markets, not because we think there's a need for intervention, but there may be.
But there may be, in the sense that super funds hold about a quarter of their assets in private markets. Is that opacity concerning?
Well, I think from the superannuation perspective, we have an extraordinary over 4 trillion Australian dollars are tied up in super, and we should be proud of that. I don't think there's an issue about that. The real issue is that there's a certain cap, not cap, but constraint on investable assets in Australia. So we want our superannuation funds to be investing globally and locally, and depending on which fund you're talking about, between a quarter and a fifth of their AUM are in private markets. They're in private, not listed assets, and so we don't want to discourage that. We want to understand it, and there's been some talk in this sector of frothiness in the private markets, and we want to understand whether that's an emerging issue or creating risks that we all need to understand, not just as a regulator, but as an industry. This is something that I think Larry Fink has been talking about. So I think my main message to the private markets is we don't want to re-regulate what's going on there, but what we want to understand is what's going on there. And we think we need more data, we need more transparency, and we'll see when we publish a report later in the year, we'll have a bit more to say about whether there's a need for any additional regulatory intervention.
Joe, can I ask you on a sort of somewhat unrelated topic, can you give us an update on what's going on with the ANZ case?
Yes. That's one of our most significant investigations, one of our most complex investigations. It remains the case that we're hoping and planning to land it one way or the other by the middle of this year, some months from now. It's probably one of the most complex markets investigations we've ever undertaken. Your viewers will know that the whole question of pre-hedging is a complex matter. There are different views about what's acceptable, what's unacceptable. So we do have concerns about what happened here, but that investigation is ongoing, and we're hoping to land it in the next few months.
It is an election year, obviously. I do wonder, when it comes to what the government can do in terms of policy settings and reforms, is there anything that would be kind of on your wish list?
Well, I think for present purposes, we're keeping our head down. The election is imminent. It's inappropriate for me to be making any significant policy asks. We're appearing at Senate estimates tomorrow. The Parliament will have an opportunity to ask us questions then. As far as this discussion paper is concerned, we're quite confident about raising the question of transparency and our data gathering powers, because we've raised it before. It's an issue that we've raised with government before, and so I'm hoping we can improve our data gathering at some point in the future.
Joe. Really great to have you with us, and pleasure to chat with you again. Joseph Longo, who's a chair at ASIC. One of the stocks that we're watching today is WiseTech. Of course, so much tumultuous news flow when it comes to this company, and WiseTech now appointing Richard White as executive chairman, really returning to the helm after months of discord there and a number of board members there resigning. So the appointment leaves him with really the job of repairing the sort of reputational governance damage that we've seen to WiseTech over the past few months. It also reported first half net income coming in at $106.4 million. Woolworths is the other one that we're watching, the supermarket retail giant, reporting first half net income that missed estimates there, and this continues to sort of feed into the broader macroeconomic outlook when it comes to Australia, given that we have had that first easing measure now from the RBA, but a lot of uncertainty when it comes to what will the sort of subsequent months will bring. There was a union dispute that weighed into those numbers for Woolworths as well. But yes, a miss on the average analyst estimate there, and we saw sales there also seeing a little bit of weakness there, as well as interim dividend per share being declared at 39 cents, softer than expected as well. The estimate was at 40 Aussie cents. We do have more ahead on the Asia trade. This is Bloomberg. Take a look at how we're seeing that set up across Asia there. We're looking distinctly risk off when it comes to that slide that we saw in the US session, these concerns about broader economic strength in the US economy. Another disappointing consumer confidence reading fueling those concerns, particularly in light of further Trump tariffs and the potential inflationary impact of these policies that are yet to be fully fleshed out. We had President Trump just posting earlier when it comes to investigating tariffs on copper as well, and speaking broadly about, wanting to sort of pair up with investors and invest in places where the US is being treated well. So more of that sort of trade rhetoric and the equivocation there. And the administration is also said to be sketching out some tougher versions when it comes to US chip curbs and pressuring key allies to escalate their restrictions on China's chip industry. It is an indication that the new US president plans to expand efforts that began under President Biden to limit Beijing's technological prowess. Let's bring in Xiaomeng, who's the Director of Geotechnology at Eurasia Group. Xiaomeng, great to have you with us. And as we said, this is really a continuation of the further sort of tightening of these restrictions that we saw even in the sort of the last weeks and days of the Biden administration, right? I do wonder how much further can the US go, and how impactful can this be, given that we've seen some developments? The Huawei story was one of them. Obviously, DeepSeek is another. Does it show that these curbs are not necessarily hitting the mark?
I think you are right about this story. I think Trump administration can continue to double down on chips restriction, whether it's an expansion of the AI diffusion rule, or they can potentially considering expanding the existing scope of export control to cover more mature nodes. But in the long run, this regulatory tool is losing its lure. It's becoming less and less effective as they expand the scope, especially considering China's DeepSeek development. It seems like the technology development trajectory has taken an unexpected turn. And in a way, the technology evolve, it will undermine the effectiveness of US export control.
Has it surprised you, I guess, the advances that we've managed to see out of Chinese tech despite these moves?
Yeah, I think when the DeepSeek moment happened, I was traveling in Asia, and I got overwhelming feedback from stakeholders in this part of the world that the US government should really think about what happened in the industry and take a moment of reckoning about their strategy on that front. But it's very clear that the Trump administration did not really want to have a second thought on this ongoing strategy against China. When you are a hammer, everything you see, it looks like a nail. It seems like they're going to go further instead of taking a pause.
I love that when you're a hammer, everything looks like a nail. It was interesting that we did see that reaction in Alibaba, right? In this sort of nascent recovery that we see in Baba and some of the China tech, do the sort of geopolitical, geostrategic pressures potentially change a fundamental recovery in the fundamental case for progress?
Yeah, I think so. I think given all the Chinese telco operators are connected to DeepSeek, all the Chinese tech companies' platforms are also part of this new revolution. I see DeepSeek is poised to democratize AI and accelerates its adoption in various sectors in China very quickly.
I wanted to ask your views on NVIDIA, right? How sustainable are the highs that we continue to see? We've seen the rally stalling due to concerns about, I guess some of the supply aspects of AI computing and the real reliance when it comes to NVIDIA. Have we peaked when it comes to this one company?
I think the recent pause is a short-term change in investor sentiment. I do believe that in the long run, the Jevons paradox will play out. It means efficiency gain will lead to increased consumption. And in the long run, it will deliver a promising outlook for NVIDIA. But in the short term, investors are reacting to a narrative shift that NVIDIA chips are no longer a choke point technology for cutting edge AI, and barriers to entry has come down, which has a significant impact on the investment community that typically operates with a much shorter time horizon.
They are arguably the sort of biggest loser potentially, right? If what we saw with DeepSeek is expanded into full potential.
Yeah, I think that seems to be the investors' take right now, and we should also take a moment to think about DeepSeek's technology progress and how sustainable that is in the long run. You could argue Mistral from France, another leading AI startup, have used similar methodology to develop their technology a few years ago. And since then, they have taken much slower pace in technology progress. So we'll see how long the DeepSeek moment will last and draw the impact on NVIDIA from there.
It's interesting. I thought the interesting takeaway when it comes to the DeepSeek developments, you're saying animal spirits is a precondition for growth. How fragile are animal spirits when it comes to China at the moment, even with the indication of stronger private sector support from the government?
Yeah, I think Chinese tech leaders will remember. Their memory are still fresh from 2020 when Jack Ma had a major accident with the party leadership and has to pare down his business empire significantly. As companies like DeepSeek grow bigger and mature, they are always subject to political scrutiny from the party. You could say productivity gains always comes from some kind of disorderly growth, but at the same time, they have to be aware of their limits. And that's a crucial way to operate in the Chinese market.
Does that way of operation, do the limitations being set because of central party control, that's not just desirable, but of course, mandatory in a lot of ways, does that by its nature curtail how big the growth can be in China?
I think right now we are seeing a moment of very fast growth, but longer term, I think the limitation is structural. Just look at the golden share structure installed in ByteDance and Didi in the past few years. That set a precedent that also give an institutionalized tool for party to rein in these companies. I think the longer geopolitical risk is not going away anytime soon.
Xiaomeng, really great to talk with you. Xiaomeng Liu, who's the Director of Geotechnology at Eurasia Group. One mover that we're seeing is Supermicro shares. They're jumping after filing these delayed financial reports, meeting that deadline for submitting the outstanding financial reports to try and regain compliance efforts and standards to stay listed on the NASDAQ, easing some of these concerns that there were worries that it would be delisted. We're seeing shares now just shy of 24% in extended trading. The company reporting those 2024 fiscal year results, financial statements for the quarters ended September 30th and December 31st as well. They had, remember, missed that August 2024 deadline and was facing that threat of delisting. Supermicro, though, at the same time, still warning of ongoing risks, including potential material weaknesses when it comes to internal controls over financial reporting, reputational harm, despite regaining compliance with those filing requirements there. So a little bit of good news, and we are seeing that reaction when it comes to the stock price. Let's get to some special coverage now when it comes to the drones arms race. It is a contest that stretches to supply chains, which right now are heavily skewed towards China. There is a push by governments worldwide, including the US, to build out new distribution channels. Our tech reporter Annabelle Drewlers explains how Taiwan wants to become a key base for production.
Our sights are set on making Taiwan the Asia hub of UAV supply chains for global democracies.
It's a bold vision, but not one without challenges. Taiwan is racing to develop a domestic drone industry capable of defending itself from China. The island also wants to forge partnerships in unmanned aerial vehicles, or UAVs, with the US and its allies. AIDC is a government-backed aerospace company taking a leading role in establishing industry collaboration in Taiwan.
We need the defense localized, the first reason. And the second reason is that I think the drone developed trend is very quickly and a very huge demand.
Yet the island's drone inventory is still relatively small, particularly when compared to that of the Chinese military. This video, which circulated in 2022, shows Taiwanese soldiers throwing rocks at suspected Chinese UAVs on an outlying island. It painted a stark picture of the capability gap.
I think Taiwan might be need what we call the chip and software. The chip means we need for the communication chip, we need for the flight control chip, and we need to have the GPS chip. So those three kinds of chip, I think is something that we need to build up our technology by ourselves very quickly.
Building up drone stockpiles is no easy task, even if Taiwan is already recognized for its high-tech manufacturing expertise. Among the challenges is economic feasibility, as local UAV manufacturers need international buyers to build at scale and to cut costs. Then there's Taipei's diplomatic isolation imposed by Beijing, which constrains its ability to export advanced weaponry and could also make countries uneasy about supply disruptions in a potential China-Taiwan conflict.
I would worry about the security of that supply chain of in the event of hostilities. How much can you rely on it?
And there's also pure business-to-business competition.
A lot of other nations are building these systems, right? I mean, one of them being China, that may wish to supply them around the region in terms of kind of regional suppliers. And then Turkey, when you're looking at kind of more traditional US and NATO allies, Turkey has a massive drone industry. I mean, they're even building drone aircraft carriers. So yeah, there's competition out there, and yeah, they're not alone.
Annabelle Drewlers, Bloomberg News.
Some of the other tech stories that we're watching: DeepSeek is reopening access to its core programming interface after a 3-week suspension. The Chinese AI company says it's again allowing users to top up credits for use. DeepSeek suspended the service earlier this month due to capacity shortages. The move came after Alibaba previewed its own rival model in a sign of deepening competition in China's AI industry. Apple investors have rejected an outside shareholder proposal to end the iPhone maker's diversity, equity and inclusion efforts. However, CEO Tim Cook said the company may make some adjustments to its DEI program. Investors also rejected requests for reports related to AI risks, child sex abuse material and charitable giving practices. More ahead on the Asia trade, this is Bloomberg. Well, climate diplomats have gathered in China this week to begin work on the next report from the Intergovernmental Panel on Climate Change. That's a crucial assessment on global warming that helps shape policy for governments and companies. But US government scientists are notably absent after the Trump administration issued a stop work order as part of a broader US retreat from research funding and climate diplomacy. The team's absence is expected to cause delays. Meanwhile, as increasing global temperatures stoke volatile weather, it's becoming more crucial for governments and businesses to receive the right messaging on weather events like El Niño and La Niña. But the world's weather agencies are adopting diverging approaches to this. Our weather reporter, Mary Hui, has more. So, Mary, I've seen even just anecdotally sort of the timing differences and the standard differences when it comes to declaring these weather events. So what are the big challenges for global weather agencies?
The challenge really boils down to this. It's balancing the demands for certainty on the one hand and what's inherently uncertain and increasingly volatile weather and climate patterns. People want certainty. They want to know what weather to expect for the day ahead, whether to wear a jacket or bring an umbrella. But they also want to know what weather to expect for the season ahead. But fundamentally, the weather and climate are uncertain things. That's all probabilities, and sometimes the unlikely outcome can happen. So how do meteorologists get that nuance across clearly? That's the fundamental challenge. And Australia last year found out the hard way in that they predicted correctly an El Niño, which usually brings hot and dry weather to Australia. But it turned out to be an abnormal El Niño in that it was very rainy, brought wet conditions and lots of flooding. So people were quite angry about that. It sparked a lot of backlash and confusion, even though the forecast for El Niño was correct. And the Bureau of Meteorology in Australia had said that no two El Niños and La Niñas are the same, but that just got lost in translation. So now Australia is trying something different and taking a less is more approach by not issuing its fortnightly ENSO or El Niño and La Niña outlooks, and instead asking people to focus more on their long-term rainfall and temperature outlooks. Now, as to whether that strategy will pan out and get messages across better, is something we have to kind of continue to watch for and compare with other agencies' strategies.
And for a lot of reasons, it's pretty important to keep that messaging right.
That's right. El Niño and La Niña, these are the two, it is the largest driver of year-to-year climate fluctuations on Earth, and trillions of dollars are at stake as governments and energy markets and farmers follow these outlooks closely and make major decisions based on it. So it's really important to get the messaging correctly and clearly to everyone who's following this. So that's clear, it's important. As to how to do it, that's a trickier question to answer, and we're seeing Australia take one tack, while the Philippines and the World Meteorological Organization are taking another tack by providing more information, not less.
And climate change obviously complicates this forecasting even more.
That's right. The scientific jury is still out as to whether ENSO becomes more variable and less predictable. But what is clear is that the background weather patterns and climate patterns are becoming more volatile as temperatures climb. So that compounds and further complicates the challenge of what's already a complex task of predicting and communicating ENSO. And on a more technical level, as temperatures continue to rise, there are concerns that we can overestimate El Niños, the warm phase of ENSO, and underestimate La Niña, which is the cool phase. So there are statistical methods to try and work around that problem, but more research is needed to figure out whether they're effective or not. So I guess one bottom line is that the science is important, it's expensive to carry out, and there are costly potential impacts if that science isn't done or funded.
Our weather reporter Mary Hui there in Hong Kong. We have more ahead on the Asia trade. This is Bloomberg. Well, investors are ramping up bets on South Korea's defence and shipbuilding stocks. Optimism is being fanned by expectations of a revenue boost for those sectors off the back of increased global military expenditure. Bloomberg Asia stocks reporter Yukon Lee joins us now. And so we are seeing this theme when it comes to increased military spending, particularly in places like Europe. So are we seeing that correlation when it comes to defence shipbuilders in Korea, despite, of course, a lot of ongoing domestic, political and economic uncertainty?
Yes, one might be really surprised to hear that some of the South Korean defense and shipbuilding shares are the best performer this year in Asia. Some of them have risen, like Hanwha Aerospace, up more than 100% during the first 2 months of this year, and that comes as because investors see that they are one of the few sectors that will see biggest earnings upgrades in coming years. Now, Goldman analysts have said the defense sector in Korea has seen the most biggest fundamental improvement in their earnings per shares in the past 2 years, and there's still expectation that these are the sectors that will see a revision upward for their earnings, and that's the biggest reason that the optimism is coming from. And what's driving that earnings upgrade is a potential increase in the global military budgets, not only in Europe but also potentially in the Middle East and South Korea. So those are what's driving this optimism. And another reason, especially for the shipbuilders, investors see the shipbuilding sector in South Korea as one of those safe zones from Trump's tariff, because South Korea is placed as the key military ally of the United States, and the U.S. needs South Korean shipbuilders to outsource their Navy ships maintenance and construction. So investors are watching one of the key bill at the Senate, in the U.S. Senate, that would allow U.S. Navy to outsource the construction of their Navy vessels outside the United States, which could give another big trigger to the shipbuilders if that Senate bill passes.
What about the outlook? Are they looking too expensive now?
Yeah, so these are our areas. Some of the debates are going on because these stocks have gained so much during the first 2 months of this year. But what I hear from investors in general is that they see the valuation in the defense sector pretty reasonable, and they have more legs to. There will be more legs in this rally. Some investors are not really comfortable with the valuations level of the shipbuilders, which has passed their historic average. But still, they don't see at this time they need to take profit and sell, because if you look at the valuation in other sectors such as tech, they look pretty stretched. So a lot of some investors still see that defense and shipbuilders could provide some shelter if there is something, some kind of a big meltdown in the U.S. tech or potential concerns in the macroeconomic conditions. These defense and shipbuilding sectors with their earnings upgrade could provide a safe haven. So that's why even at these valuation levels, a lot of investors are very hesitant to sell.
Bloomberg Asia stocks reporter Yukon Lee there. Let's get you caught up with some of the corporate headlines that we're following. And OCBC has reported net income for the fourth quarter that missed estimates. It's also announced plans to return $1.9 billion of capital to shareholders over 2 years via special dividends and share buybacks. Singapore's second largest bank is following the city's two other major lenders in returning excess capital to investors after record earnings for the year. Tesla shares fell sharply in New York, pushing the EV maker's market capitalization below the coveted $1 trillion mark. The stock has been on a downward slide since mid-December amid concerns over slowing sales and Elon Musk's political activities. Sales plunged 45% last month across Europe as Tesla struggled in key markets, including Germany and the UK. Well, the market opens in Seoul and Tokyo are next as we continue to see that downside sentiment coming after the consumer confidence numbers really stoked ongoing US economic worries. We're seeing a pretty muted start to this morning's trading here in Asia. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens as economic pessimism spreads. U.S. consumer confidence falling by the most since 2021. Haidi, oil prices also at the lowest this year given the weaker demand outlook. We'll see if Asian equities can outperform, but we saw that sell-off on Wall Street.
And of course, lots more concern when it comes to China tech. Asia tech, Nvidia numbers are on tap, as well as, of course, these broader concerns over President Trump's tariffs and tech curbs on China, how that could potentially result in slower growth, not just, in these key markets, but of course, across these big tech names as well. All of this kind of wrapping up into a pretty risk-off session.
And that risk-off sentiment already being translated into the strength of the Japanese yen. We're talking around levels that we haven't seen in around 4 months or so for the yen, holding at that 149 level against the greenback. We have been watching, of course, the BOJ tightening moves as well. And today, for example, we are getting news that that annual budget is really being negotiated by Japan's minority government has reached an agreement with the opposition. So perhaps a little bit of a boost in sentiment coming from that side, but the Nikkei still down 0.3%, and of course a lot to do with the tariff threats. If you look at the Kospi, for example, coming online right now, we have seen those threats of really wider semiconductor curbs coming from the U.S. already being felt across a sentiment in South Korean equities. It was down in the previous session. The Korean won also was weaker. You can see the Korean won strengthening a little bit against the U.S. dollar. We also had, of course, the much expected BOK rate cut this week as well.
Yeah, and Shery, take a look at, we're just an hour into the trade here in the Australian session. A little bit of downside there, 0.4%. We've seen really over a week of softer trading when it comes to Australia, despite a momentary sort of ending in the green for the previous session. But this is the picture as we take a look at the Aussie dollar. Broadly, we are seeing that sort of dollar weakness, US dollar weakness, I should say, playing out when it comes to the likes of the Aussie, when it comes to the likes of the Japanese yen, as you hinted at a little bit earlier there as well. But we are seeing that upside. 63.52 is where the Aussie is trading at the moment. We're also treasuries on watch when it comes to treasuries, right, as yields slid to that 2025 low. The 10-year yield dropping to 4.29. That's really, again, in reaction to that softening economic data, the consumer confidence numbers, and all of this feeding into, of course, the Fed, what they can do, and what further implications, Shery, we could see from trade and tech-related decoupling.
Let's delve into all of this and bring in Daniel Lam, Head of Equity Strategy at Standard Chartered Wealth Solutions. Daniel, always good to have you with us at a time when we're seeing U.S. stocks continue to fall, the weakest levels in about 5 weeks. But Bank of America now saying that perhaps we are not really factoring in the upside risks coming from Nvidia. First of all, take a look at this chart because we're seeing Nvidia sort of at the cheapest levels going into earnings in about a year. Given the importance of this stock for the broader market, could it really salvage this equity rally that we've seen in the U.S., especially after the Magnificent Seven fell into correction territory now?
Well, there are new factors at play nowadays in the markets. So the DeepSeek is a big factor. If you look at the gap between Chinese equities and the MSCI All Country World equities, the Chinese equities are still trading at 45% discount, which is more than 1 standard deviation away from the 10-year average. So basically what we're seeing is that there has been rotation of funds from US equities into Chinese ones. So that's what's been happening in terms of the valuation that I highlighted and also the possibilities that China tech had to offer. So before, people were seeing that the US tech is the only game in town. Now things are a little bit different.
This is what the broader markets think. But Daniel, when I look at your notes, you're actually pretty neutral on Chinese equities and you still prefer the US. Why?
Okay, so there are a few things. So Chinese equities overall we're neutral, but within Chinese equities we are favorable on the technology stocks. So it is a story of high end versus lower end. So previously, US technology, the only game in town, but now things need to be differentiated because the Chinese DeepSeek shows that they are capable of entering that tech space, applied at a lower end level, and basically people have to take account of that. In the longer term, what we see is that the US is still going to be dominating in the high end of the tech space. Right? They're going to take that. They're going to keep that. But then the Chinese, they do have a share of that. Okay, so right now, because of the expensive valuation in the US tech, you probably will see a little bit more rotation to come in the near term. But in the long term, we're favorable.
I wanted to ask a bit more about what you see as sort of opportunistic moments in China, right? What are you looking for at this point?
Well, at this moment in time, we've seen a big rally in the Hang Seng Index, right, from just below 19,000 to above 23,000. So that's pretty fast and furious. So in the near term, there could be some correction, especially with the chip restriction news coming to the US. But then our point is that if they can make something like DeepSeek, then the box has been opened. Right? There are other possibilities available for different Chinese technology sectors. So that's what will be keeping the market going about China tech. Probably there will be some correction, but then Hang Seng to about 21,600 to 22,000 is good level of entry for the longer term investors.
For a longer-term investor, taking a look at Indian stocks, the Nifty 50 is trading near the lowest level since about June. How's the sort of sentiment there, and do you think that now kind of presents a good value point to re-enter?
Well, in terms of valuations, back to 5-year average for Indian equities. Right now, I believe that the longer-term opportunities still exist. The government's budget has been stimulatory, in various areas, so that's encouraging. The earnings is still reasonable, but then at this moment in time, I think people are just more focused on the China story right now because it's been very quiet for a long, long time in China. So people are focusing on that. But Indian equities, we do believe that on the 12-month horizon, there is upside from here.
On the other hand, it's been pretty noisy when it comes to Japanese equity markets just because of the interest that we've seen from global investors. What will a stronger Japanese yen mean for the equity markets here and that rally that we saw last year? Can it continue into 2025?
I think Japanese equities, you've got to be more differentiative, right? So we have a neutral overall, but in terms of the sectors, areas that we like, will be the financials, because we do see that the Bank of Japan is going to be pretty much the only central bank that will be tightening this year. And stronger yen, steeper yield curve is favorable for the financials.
Daniel Lam, Head of Equity Strategy at Standard Chartered Wealth Solutions there. These are some of the stocks that we're watching right now as Tesla is moving downside of 8% at the moment. Some of those suppliers on the left side of your screen, you can see a little bit of divergence in some of those names. Right, we have more ahead on the Asia trade. This is Bloomberg.
I'd like to buy minerals on Russian land too, if we can. The rare earth, they have very good rare earth also. They both do, I would say that, and oil and gas. Look, it's a great thing if we settle this. It's great for Russia too, because we can do deals there. They have very valuable land that isn't utilized. So something like that could take place, yeah.
Have you put raising or lifting sanctions against Russia on the table?
No, we haven't lifted any sanctions on anybody.
On the table as part of any negotiation?
I guess it will be at some point. But
President Trump telling reporters that the U.S. wants to buy Russian minerals and may consider lifting sanctions on Russia. Sources also saying that Ukrainian President Volodymyr Zelenskiy plans to visit Washington on Friday to seal a minerals deal with the United States. Let's bring in Bloomberg senior editor Derek Wallbank. Of course, there were questions, Derek, on whether this would actually go ahead, given that Ukraine was not too happy about the terms of that minerals deal. What do we know at this point?
Yeah, that's right. And this is a major development, I think, if this goes through and if this is signed. This will be a major development in the Trump-Ukraine relationship. Remember, that has been far more strained than it had been under Trump's predecessor, Joe Biden. Biden had been talking about ironclad security deals and no problems on the military thing. Trump has now pulled a lot of that into question with some of the moves that he's made to reach out to Vladimir Putin without Ukraine, without Europe necessarily at the table. Now, the contours of this deal remain still a little bit unclear right now. There have been some moves kind of in the Ukraine direction, but Ukraine has been seeking firm guarantees from the U.S. about what it's going to be able to offer Ukraine going forward. The Trump administration had been suggesting that it was perfectly happy to do some economic guarantees, but Ukraine has been really focused on military guarantees. The other thing that I think is really important about this is the question of if the U.S. is going to be developing or helping develop resource rights. Where is that resource right development going to take place, right? Vladimir Putin suggested a little bit coyly the idea that the U.S. could maybe help on resource development with land that Russia currently occupies. Obviously, that would be a non-starter for Ukraine. But the idea of an American presence there on some land that might be at risk for Ukraine and whatever final settlement might be could be something that could be a guarantor in addition to actual European security forces and whatever situations they may wind up being.
Derek, we're also seeing significant developments in Europe, right, in particular when it comes to the UK agreeing to increase defence spending. This is in reaction to President Trump saying that he wants to withdraw security guarantees for Europe.
Yeah, I mean, look, we've talked before earlier this week. I think one of the foundational things that has come, particularly in the last couple of weeks, is a realization in Europe that, whatever you want to be the case in terms of America's role in Europe, particularly on Europe's Eastern Front, that's not necessarily going to be the case. And so you are starting to see some moves, Sir Keir Starmer's move in the UK to increase defense spending as a target, that coming in a couple of years, out of Germany saying that we have to be prepared for to stand on our own and rebuild defense capacities. France as well is making some comments in that direction as well. There's a sort of realism coming over the continent that the U.S. as a projection of power guarantor is probably not going to continue in that historic role in the guaranteed way that it had before, certainly during the Cold War and in the decades that have followed. So there is going to be a military buildup in Europe, according to the European leaders. That is going to cost an awful lot of money. There are going to be ramifications, both in terms of the spend there, as well as what that increased spend may limit the resources to be able to do or require fundraising in some other way. So there's a lot to be worked out here. But I think we will look back at these last, especially maybe 2 weeks, as a period of time where Europe realized that it had to fund this itself, whether it wanted to or not. It just simply has to.
Bloomberg senior editor Derek Wallbank there, taking a look at some of the other stories that we're following this hour. And Hamas says it has reached an agreement for Palestinian prisoners to be freed by Israel. The group had earlier refused to continue talks for a second phase of the ceasefire until they were freed. Meanwhile, Israel suggests that it wants to extend the Gaza ceasefire when it expires this Sunday. But the Israeli foreign minister told his European counterparts that an extension will not happen without more hostage releases. Australian Treasurer Jim Chalmers says he's had very constructive talks with the US Treasury Secretary Scott Bessent. A key part of Chalmers' agenda in Washington was talking to US officials about avoiding President Trump's tariffs on steel and aluminium. They also discussed improving critical mineral supply chains and mutual concerns around China. South Korea's impeached President Yoon Suk-yeol says he would dedicate the rest of his term to constitutional reform if returned to power. The Constitutional Court is wrapping up a trial on whether to permanently remove him from office for his short-lived martial law declaration. The ruling could trigger a presidential election within 60 days. Let's turn to our coverage when it comes to the drones arms race. It is a contest that stretches to supply chains, which right now are heavily skewed towards China. But there is a push by governments worldwide, including the US, to build out new distribution channels. Our tech reporter Annabelle Jewellers takes a look at how Taiwan wants to become a key base for production.
Our sights are set on making Taiwan the Asia hub of UAV supply chains for global democracies.
It's a bold vision, but not one without challenges. Taiwan is racing to develop a domestic drone industry capable of defending itself from China. The island also wants to forge partnerships in unmanned aerial vehicles, or UAVs, with the US and its allies. AIDC is a government-backed aerospace company taking a leading role in establishing industry collaboration in Taiwan.
We need the defense localized, the first reason. And the second reason is that I think the drone developed trend is very quickly and a very huge demand.
Yet the island's drone inventory is still relatively small, particularly when compared to that of the Chinese military. This video, which circulated in 2022, shows Taiwanese soldiers throwing rocks at suspected Chinese UAVs on an outlying island. It painted a stark picture of the capability gap.
I think Taiwan might be need what we call the chip and software. The chip means we need for the communication chip, we need for the flight control chip, and we need to have the GPS chip. So those three kind of chip, I think is something that we need to build up our technology by ourselves very quickly.
Building up drone stockpiles is no easy task, even if Taiwan is already recognised for its high-tech manufacturing expertise. Among the challenges is economic feasibility, as local UAV manufacturers need international buyers to build at scale and to cut costs. Then there's Taipei's diplomatic isolation imposed by Beijing, which constrains its ability to export advanced weaponry and could also make countries uneasy about supply disruptions in a potential China-Taiwan conflict.
I would worry about the security of that supply chain of in the event of hostilities. How much can you rely on it?
And there's also pure business-to-business competition.
A lot of other nations are building these systems, right? I mean, one of them being China, that may wish to supply them around the region in terms of kind of regional suppliers. And then Turkey, when you're looking at kind of more traditional US and NATO allies, Turkey has a massive drone industry. I mean, they're even building drone aircraft carriers. So yeah, there's competition out there, and yeah, they're not alone.
Annabelle Jewellers, Bloomberg News.
As we continue to see the growing rivalry between China and the United States over chips and advanced technology, we're seeing Tokyo Electron drop almost 5% at the moment. Of course, Bloomberg had learned that Trump officials recently met with Japanese officials about restricting Tokyo Electron's engineers from maintaining semiconductor gears in China. We're seeing now the downside to the stock, as also it was cut by Morgan Stanley to equal weight. We have more ahead on the Asia trade. This is Bloomberg. We continue to see some pressure on Treasury yields at the moment. Of course, we had seen the 10-year yield fall to the lowest levels of the year. Economic pessimism really spreading across the United States. Consumer confidence falling this month by the most since August of 2021. We're talking about a drop in confidence that was pretty broad across age groups and incomes. And we are now seeing the market fallout, including in U.S. equities, falling to a 5-week low. But that Treasury rally continuing across the board. We also heard from Bank of America CEO Brian Moynihan saying that overregulation of lenders is the main reason why some customers are being shut out of the U.S. banking system and not political bias. In a conversation for Bloomberg with David Rubenstein, Moynihan also spoke about working with various U.S. administrations and changing regulations.
There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area, where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody. But the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right. And I think it opens a dialogue about how to get these regulations correct. At the end of the day, we're open for everybody. We serve millions and millions of Americans, trillions of transactions a year, and we'll continue to do so.
Okay, so when this administration was elected, there was a lot of, I would say, jubilation in the streets of the banking world. People thought that the banking regulation had been too tough under President Biden. Some people thought that regulation would be more amenable to banks. Has that turned out to be the case yet, or is it still too early to know? And is the banking community happy with the direction that the current administration is going, or you just don't know yet?
Well, so you have to sort of step back and say, the regulation of banking has always been true since our charter, our oldest part of a bank was from 1784. So we've been regulated from that day forward. If you think about the great financial crisis and Dodd-Frank and a lot of capital rules and liquidity rules and all that stuff came in, there was a reason for the world writ large to be really not happy with banks. And non-banks that became banks, Goldman Sachs, Morgan Stanley, Merrill, et cetera. So you could understand that. When you go fast forward through the 15 years hence, plus you go through the pandemic and the banking system stands up and stabilizes the economy. You go through the regional banking crisis, the banking system steps up and stabilizes it. And they keep adding capital and liquidity. You're sort of saying, wait a second. We are a source of strength. And by the way, the American banking industry is really a source of strength. So the pendulum kept just swinging, even though the reason why it had swung had stopped. And so our industry was saying, wait a second. Why are we have 20% more cash during the pandemic? The risk is the same. It's just by mathematical creep of calculations. Why are you saying we're going to limit your fees charged for a certain activity or deem an activity a loan when it wasn't a loan? And with hundreds of years of history saying an overdraft is not a loan, somebody just says, I want to make it a loan. And so this idea of the regulators sort of imposing new rules and regulations that Congress did not intend, actually, was kind of an interesting question.
You can watch more of that interview on the David Rubenstein Show, Peer-to-Peer Conversations, airing March 12th in New York, 13th if you're watching in Hong Kong. Well, the European Union is planning to walk back significant chunks of planned ESG regulations to protect business interests of the bloc. According to documents seen by Bloomberg, the European Commission is proposing to water down regulations covering everything from ESG reporting to reporting requirements, to supply chain management. The proposal has been met with criticism from lawmakers and civil society groups. Take a look at how futures in Europe are opening at the moment, and this as we really see that downside really bleeding through to the Asian session from those consumer confidence numbers in the US. We could see a little bit more potentially upside when it comes to trading in futures, indicating for European stocks. We are seeing Euro Stoxx 50 futures up by just about 0.5%, and a little bit more optimism when it comes to German DAX futures as well. We have seen quite a lot of European stock gains this year. In particular, banks will be one to watch again in the session. That rally now being extended this year to 21%. More ahead on the Asia trade. We are getting Australian CPI numbers just crossing the Bloomberg now. 2.5% is the year-on-year, a little bit softer than expectations of 2.6%. Still, headline inflation continuing to show that pickup, but well within that 2 to 3% target band for the RBA. The prior reading was also unchanged at 2.5%. The trimmed mean year-on-year at 2.8%. That showed a slight acceleration from the 2.7% in the previous reading. And of course, we're also seeing that sub-gauge when it comes to construction work as well, seeing a gain of 0.5%, given that it's been such a source of consternation when it comes to accelerating home prices here. But this is a picture as we see what the Aussie dollar is doing. The expectations are fairly muted when it comes to what further easing we could see from the RBA. Certainly not high expectations for that April meeting. And in fact, most economists have baked in perhaps 100 basis points total when it comes to this year, potentially even less, depending on, of course, some of the domestic inflation factors there. Given that it is an election year, we could see quite a bit of election spending, as well as the implications of Trump tariffs and potential counter tariffs there as well. But consumer prices rising 2.5% from a year earlier in that latest reading, a little bit shy of that median estimate there. Bloomberg Intelligence continues to expect a gradual pace of easing, with their view on the next rate cut to come in May. Take a look at what we're watching when it comes to trading in bonds across the region. And of course, we continue to watch that lead from treasuries that we saw overnight as we continue to get that reaction from that consumer confidence reading that really kind of created a lot of consternation about potentially the economic weakness that could be facing the US forecast. Yields there for Treasury certainly sliding to that 2025 low, with that 10-year dropping to about 4.29% there, and that decline in yields also being driven by some of these Trump tariff policies, the decline in US stocks there as well. Traders at the moment when it comes to the Fed pricing in 2 quarter-point cuts this year. So, Shery, a pretty muted outlook there when it comes to the ability of some of these central banks to contend with the global trade headwinds.
Yeah, and you can see that reflected on the equity space today in the Asian session. You can see the Nikkei falling 0.9%, being lower by information tech, energy stocks as well. The Kospi is also down 0.2%, and really continuing those declines that we saw from the previous session. Of course, chip restrictions from the U.S., a key concern here as we continue to see the tech rivalry between the U.S. and China. We'll be watching the offshore yuan very closely because it's been holding steady. But given these concerns about more measures coming from the Trump administration, we have seen that increased downside pressure. Bloomberg now learning that China is increasingly scrutinizing outbound investments by domestic companies over those concerns about capital outflows and depreciation pressure on the yuan. Let's bring in our China correspondent, Min Lo, in Hong Kong. Min, so how difficult is it for companies now to send direct investments overseas?
So we're hearing from sources now that authorities have been informing China-incorporated companies that are seeking a listing in Hong Kong or a secondary share sale in Hong Kong that they now have to seek a no objection indication from SAFE, which is the forex regulator in China, in order to deploy their funds overseas. Otherwise, they'll have to repatriate these share sale proceeds back to mainland China. And authorities are also more closely scrutinizing any money that is sent overseas in the name of direct overseas investments. This is over concerns that companies companies could be faking these transactions in order to move money out of China. And this came after China saw about close to $170 billion in outflows, investment outflows from Chinese companies last year that has been putting a lot of downward pressure on the yuan. Of course, a lot of that pressure also coming from fundamental reasons, including the interest rate differentials between US and China, the domestic economic slump in China, and the Trump tariff threats as well. So these measures will likely help to support the yuan. And we know that in the past, SAFE, which is the forex regulator, used to have a lighter hand when it comes to these stock offerings overseas, including in Hong Kong. These companies usually have greater autonomy over how they spend or deploy their funds overseas. But now they're also being told that they need to keep SAFE as well as other relevant authorities updated of their share sales process in Hong Kong. And that comes as we just are starting to see this revival in the IPO pipeline with a jumbo listing from CATL that is highly anticipated coming up in the next weeks or months.
We saw Chinese stocks really whipsawing yesterday over these worries about the tougher Trump stance on China. So what do we expect at the moment in terms of, the sentiment really taking a hit now?
Yeah, so yesterday was a pretty volatile day. The Hang Seng Tech had reversed losses of as much as 4.4% and closed the day just about 1.5% on the downside. And that's after a big sell-off in the U.S. session, if you recall. But overnight, the U.S. session actually recuperated some of that losses. If you look at the Golden Dragon, was up about 0.5 percentage points, if I remember correctly. And even Alibaba as well, also gaining about 4% overnight in the U.S. after that big sell-off, close to around 10% sell-off the day before. And we are seeing this sort of emerging divergence in sentiment between U.S. and Chinese consumers because if you look at how Baba stock has been performing in the U.S. versus in Hong Kong, for example, you can see that actually Chinese investors are still pretty optimistic, and traders that we talk to in mainland China are saying they are still putting money in these Chinese equities. They still believe that there is more room to run and that the deep-seek factor is quite a fundamental sort of factor for re-rating Chinese equities. And yesterday, in fact, is one of the top 5 days we have seen in terms of southbound flows into Hong Kong. Chinese investors pouring in about $2.8 billion into Hong Kong stocks. So a few competing narratives here going on. There's Trump's toughening stance on China and the idea that that will only cause Chinese companies to double down on their self-reliance policy. And there's also the NPC next week that could possibly be another catalyst for market moves. So these different competing narratives, I guess, they will be tussling to figure out which will be the bigger force in shaping market moves in the coming weeks.
Bloomberg's China correspondent Min Min Lo there. And in the latest episode of the Big Take Asia podcast, we delve into President Xi's shifting stance on China's tech leaders and where the industry can go from here. You can find that on Apple, Spotify and iHeartRadio. Well, Hong Kong officials will unveil plans to address the city's mounting challenges in the annual budget to be delivered today. For more, let's bring in Bloomberg Intelligence Senior APAC Real Estate Analyst Patrick Wong. So, Patrick, is there an urgency for Hong Kong to roll out new supportive measures for the property market?
We see the challenge of the weakening property market in Hong Kong, which also impacting the overall fundamental here on the government side. I think the challenge for the government is in terms of the land sales revenue, it dropped quite a bit over the past 2 years. In the past, they contribute over 20% of the total revenue in Hong Kong. Now it's just low to mid-single digit. So that means for the government, they have some urgency to support the property market, especially the housing market, to drive the land sales for the developer side. So that would be pretty good to see what's happening for today's budget speech.
Yeah, I mean, given that property prices are now near the lowest since 2016 or so, what are some of the potential measures that could come out that could help ease the pressure on the property market? Because we have seen some measures, they just haven't really been felt across the board.
Yes, exactly. I think that is an interesting one because I think over the past 1-2 years, we see the government roll out several measures, like they basically stamp duties in the past overseas people or mainland Chinese coming to buy, they need to pay extra stamp duty, is no longer there. So that's also the things that further cut of the stamp duty could happen. Or I think another way to see is the capital investment entry scheme, that is to attract those mainland Chinese or others overseas people coming to Hong Kong for invest. They need to invest at least 30 million Hong Kong. But now I think the challenge is that the residential purchase, they just can't only 10 million Hong Kong. So there's also further relaxation to attract more buyers here to buy the housings here in Hong Kong to support the overall market. So we see the price already down 30% for the home prices over the past few years, back to the day 2016 time. So potentially we need more support to drive the land sales and also the home prices here.
How do you see the major developers being impacted?
Yes, the market, I think, for lots of developers like Sun Hung Kai or New World Development, they have the challenge in the past that the luxury home sales is not doing too well. Until recently, I think potentially we could see more opportunity when the government relax several measures further, then they can attract more Chinese buyers coming to Hong Kong. So we also did a BI survey just published today that we're also showing that the survey results that is large apartments, we also get some kind of demand. So hopefully they will also drive the developer sales in the coming months.
Bloomberg's Patrick Wong there taking a preview look at what we can expect from the Hong Kong budget, especially when it comes to the property sector. Here in Japan as well, the minority government has reached a deal with the opposition Japan Innovation Party to pass the annual budget. This clears a major hurdle for Prime Minister Shigeru Ishiba, whose leadership was shaken when the ruling party lost its majority in the lower house barely a month after he took office. The budget includes expanding subsidies for households with high school students and considering cuts to national health insurance costs. We have more ahead. This is Bloomberg. Wall Street bankers are racing to grab a slice of Chinese EV battery maker CATL's $5 billion Hong Kong IPO. This despite low fees and a U.S. blacklisting. Bloomberg Asia equity capital markets reporter Julia Fioretti joins us now. Julia, why was the competition so fierce for this deal?
Well, Shery, as you said, this is a landmark deal for Hong Kong. It's going to be the largest, or is expected to be the largest in about 4 years, so since Kuaishou back in 2021. And Hong Kong hasn't seen many, or hasn't seen rather any multi-billion-dollar listings in the last few years. So the competition was extremely fierce to get onto this, precisely because it's such a landmark, and it's probably going to be the biggest this year. And any bank that is looking to have its name and make some fees on this obviously will want to be on the deal, given the sector is also a pretty important one. So that's why there was so much competition. There's not much to go around. A lot of the deals are quite small. And Hong Kong is only just coming out from a years-long slump in IPOs, basically, and this is probably basically sort of the start of it to hopefully come out of that.
As you've sort of suggested, this is a pretty key deal for Hong Kong, right? Is there the expectation that it could kick off a bit more confidence?
Certainly. A lot will obviously depend on how it does, and there's a lot of uncertainty with geopolitical tensions with the US. But that being said, if this deal gets done and it gets done well, that will certainly give people a lot of confidence. It will also depend on the investor demand. But this is already a very well-known company. It's a leader in its field. So the expectations are that it will sell well. And hopefully that will lead to more deals coming, and it's sort of part of a trend that we're seeing of mainland China-listed companies coming to sell shares in Hong Kong, and that's what makes up the bulk of the pipeline this year. So the fact that the largest one this year has to do well, and obviously it's such a landmark deal, will sort of be a great boost for Hong Kong, given that we haven't seen such large deals in recent years.
Bloomberg Asia equity capital markets reporter Julia Ferretti, and of course CATL, one of the big suppliers of Tesla as well. Here's a little bit more about Tesla because shares fell sharply in New York, pushing the EV maker's market cap below the coveted $1 trillion mark. The stock has been on a downward slide since mid-December amid concerns over slowing sales and Elon Musk's political activities. Sales plunged 45% last month across Europe as Tesla struggled in key markets, including Germany and the UK. U.S. Steel and Nippon Steel are reportedly seeking meetings with the Trump administration. News website Semaphore says the CEO of U.S. Steel wants to talk to Vice President J.D. Vance, while Nippon Steel wants to meet with Commerce Secretary Howard Lutnick. No official meeting have been scheduled yet. Nippon Steel on Tuesday reiterated its goal of acquiring U.S. Steel for $14 billion. OCBC has reported net income for the fourth quarter that missed estimates. It's also announced plans to return $1.9 billion of capital to shareholders over 2 years through special dividends and share buybacks. Singapore's second largest bank is following the city's two other major lenders in returning excess capital to investors after record earnings for the year. Bloomberg has learned that Hooters and some of its creditors are considering a potential bankruptcy plan that would see control of the brand returned to former executives and the one-time parent of the chain. The plan would involve Hooters' largest franchisee, HMC Hospitality Group, teaming up with creditors to control the company. The casual dining chain is working with Ropes & Gray to ready a bankruptcy filing in the coming months.
Shery, take a look at what we're watching when it comes to the moves in cryptocurrencies. It is another down day as the broader crypto sell-off really gathers steam. Bitcoin there falling another 0.7%, under that $90,000 level, the lowest level since about mid-November last year. This is really a broader retreat that we're seeing across risky assets, but we've seen Bitcoin, for one example, the value falling roughly 20% since the Trump inauguration. Investors really staging that retreat due to some of the macroeconomic uncertainties, concerns about a reflation when it comes to these tariffs, and also seeing some industry-specific setbacks as well, a major hack, a meme coin scandal as well. So we're seeing other cryptocurrencies also falling in line with that theme. Ether there, for example, down by 1.5%. Solana there down as it has been for most of the session. One index tracking the top digital tokens on pace for the biggest four-day drop since early August. Shares of Robinhood also under pressure amid that sell-off in crypto. But CEO Vladimir Tenev tells Bloomberg that he still expects crypto and AI to shape the company's future. He also spoke to us about the challenges for retail investors.
What can you invest in? I mean, NVIDIA and to some degree Tesla, but no OpenAI, no Anthropic, all these companies that are doing humanoid robots, a lot of them are private. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
You said you're talking to anyone who's doing interesting stuff in the space right now. What about on the regulation side? Are you talking to folks actively in the Trump administration who are working on crypto, who are working on AI?
Right, who have given you some indication of how soon you can get this done?
Yeah, I mean, I'd say that when we talk to folks in the administration, everyone's really motivated to make the U.S. the leader in this industry. There's these two technological shifts that are happening, crypto and AI, and they're happening simultaneously.
Have you been able to speak with David Sachs?
I have, yeah. I've known him for a while. I think I'm excited about David Sachs coming in, and actually, if you saw our investor day, crypto and AI are the two technology trends that we believe will shape Robinhood's future and the future of the financial industry. So actually seeing that the government is aligning itself with these trends and making sure that the U.S. is number one I think it'll help us. It'll help the companies like Robinhood that are trying to be on the leading edge of these industries.
You know, I appreciate your note there on regulation having its place, because more recently, a lot of people in the crypto industry very excited about a pullback. And while you can understand that the way the last couple of years have gone, you have seen this exuberance that has pushed many, many retail investors into very many meme coins. You have seen an acknowledgement here that listing standards might start to loosen up. What do you make of the meme coin frenzy that probably doesn't look that good to many people today?
Yeah, I mean, I think that this is a new thing. I think the use cases of different types of coins are yet to be discovered. People are innovating very fast in the space. But two things. One, the fact that it's so easy to create a coin and tap into global liquidity and actually like the creation process. You know, you can sit down in front of some software, create a coin, and have it be trading and, you know, access to investors in 5 minutes. That's a scary thing, but it's also an incredibly powerful thing if you juxtapose it with how cumbersome the IPO process is. And it takes months, companies aren't doing it. And that's why I think tokenization is so interesting, because if you juxtapose these things, it's so clear what the benefits would be of bringing crypto technology, in particular, these like the ease of listing and tapping global liquidity into real world productive assets.
That was a Robinhood market CEO speaking with Bloomberg Sonali Basak and Tim Stenovich. We have more ahead. This is Bloomberg.
Well, we are watching this now renewed vote, Shery, in the House. House Republicans being abruptly called back, calling lawmakers back for a vote that kind of saw an initial stumbling block in the drive to leverage unified Republican control of Washington to try and push through with some speed President Trump's tax and spending agenda. We saw House Speaker Mike Johnson earlier delaying a vote on the budget in the face of continuing opposition, a clash internally amongst the Republicans, but they have now been quickly called back, Shery, to the chamber for another vote.
And this is so important because it really has that point of extending the expiring 2017 Trump tax cuts, right? So failure to pass a House budget would put that plan at risk right now. We have seen, of course, the chaos around the U.S. debt ceiling. It could slow those efforts of lifting the ceiling as well. And also there's a lot of political wrangling and a political gamemanship here at play, because this budget blueprint is also the first step in this process that allows Republicans to bypass Senate Democrats when it comes to legislations related to taxes, also spending. And without this budget, Republicans would have to win over at least some Democratic senators to pass those bills. Right now, Democrats are not wanting to pass that bill because they think that this would be more of a tax cut for the wealthy and not necessarily help the poorer segments of the American population. The $2 trillion in cuts would be focused also on mandatory programs like Medicaid, food stamps, and education funding as well. But of course, we continue to watch all of the policies around the Trump administration and also trade tensions and tariffs aimed at China. Take a look at how we're setting up for the market opens, especially when it comes to A50 futures, pointing to the upside of 0.3%. We closed higher despite the fact that, as I mentioned, the threats are there. We're talking about more potential curbs when it comes to semiconductor equipment, also just the growing rivalry between Washington and Beijing. But this divergence when it comes to U.S. equity markets selling off, and on the other hand, Chinese equities actually outperforming, is what we'll be watching in the session today. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. This is Bloomberg.